What if you could take your daily coffee money and actually turn it into a small fortune? I know, it sounds like one of those clickbaity things, but someone actually put it to the test. They invested just $5 every single day for one whole year. And the results? Well, they're not what you think. Okay, let's just start with a massive number, $1.6 million. Seems totally random and disconnected from a tiny daily habit, doesn't it? Well, believe it or not, that's the mind-bending power of compounding. If you get average market returns, just $5 a day could potentially snowball into over $1.5 million in about 45 years. But yeah, I get it, that is a long time to wait, and a lot of us are pretty skeptical about these far-off promises. And look, that is a totally fair point. The biggest objection you hear is that the payoff is just too far away. We all want to enjoy our money while we're young, not wait until retirement, right? This exact feeling, this skepticism, is what kicked off this whole experiment. So the challenge was set, and it was super simple. Invest £5, that's about $6, every single day for 365 days straight. No complicated strategies, no huge upfront investment, just a small, consistent habit to see if it could actually make a real noticeable difference in the short term. So how was this all put together? Well, it really just breaks down into 4 simple steps that pretty much anyone can follow. It boils down to these 4 things. First, you find a platform. Second, you open the right kind of account, protect your money. Third, you choose what to invest in. And finally, the secret sauce. You automate the whole shebang. Now, when you're investing small amounts every day, your choice of platform is crucial. You've got to have low fees so they don't eat away at your profits. It obviously needs to be secure and easy to use with a solid auto-invest feature. And maybe the most important part, it has to offer fractional shares. That's what lets you buy a tiny slice of a huge company, even with just $5. All right, next up is the type of account you use. Now, with a standard investment account, any profit you make, the taxman is going to want a piece of it. But with a tax-advantaged account, your money gets to grow completely shielded from taxes. And that makes a massive difference. So this account B is a tax-advantaged account. If you're in the UK, it's called an ISA. If you're in the US, it's a Roth IRA. Using one of these means every single penny of profit you earn is yours to keep. So for this experiment, picking the ISA was a total no-brainer. Okay, now for the fun part. What do you actually invest in? You could go out and buy individual stocks in a few big-name companies. The only problem is if one of those companies has a rough year, it can seriously drag your whole portfolio down. All your risk is kind of concentrated in just a few spots. The alternative? An index fund. Instead of picking and choosing a few stocks, you're buying a tiny little piece of hundreds, sometimes thousands of companies all at once. This gives you instant diversification, which spreads out your risk and makes your investment way more stable. For this challenge, an S&P 500 index fund was the perfect choice. And finally, automation. This is the key. By setting up an automatic daily investment of £5, you're using a strategy called dollar cost averaging. It sounds fancy, but it's simple. When the market is down, your £5 buys more. When it's up, it buys less. It completely takes the stress and emotion out of trying to time the market. So, with everything set up and running on autopilot, the experiment officially began. Let's see what happened after one full year of just letting it run. So the journey was definitely not a straight line up. After 1 month, the portfolio was up a little bit, but by the end of month 2, it was actually losing money. Now, this is the exact moment most people panic and sell. But by sticking with the plan, things turned around. Big time. At the 6-month mark, it was up over 18% and pretty much held steady to finish the year with a really solid gain. So the automated investing stopped right at the 1-year mark. But the money was left in the market for a few more months just to see what would happen. And this is where things got really interesting. Over the course of the entire experiment, the total amount of money actually put in was £1,505. I mean, that's a decent chunk of change, but remember, it was built just £5 at a time. After about 17 months in total, that initial investment had grown to £1,972. That means the total profit, money that was made from nothing but consistency and market growth, was £467. In US dollars, we're talking over $575 of pure profit. But here is the truly jaw-dropping number. That profit represents a total return of 43.8%.
I mean, that is an absolutely colossal return that proves this simple, boring strategy can work and work incredibly well. So, beyond the really impressive numbers, what's the single most important lesson we can take away from this whole 1 year experiment?
It really comes down to that classic investing principle you hear all the time. Time in the market is so much more important than trying to time the market. Just think, if the plug had been pulled back in that second month when the portfolio was down, all of these amazing gains would have been completely missed. The key wasn't being a genius who picked the perfect day to invest, it was just staying in the game through the ups and the downs. This entire journey started with a simple, consistent action that honestly seems too small to even matter. But it proves that you don't need a lot of money to get started. So the real question this experiment leaves us with is, what small amount could you start with to begin building your own future?